Now, the plan is to live trade. I always like to live trade because, I can barely put two sentences together. But if the markets are moving, I can make stuff up as we go. All right. The internet is not so hot. I mean, it's coming and going. I'm long gold. I have no idea where gold's at. Does anybody have an accurate quote on where gold's at? One of the trades that I'm going to teach you, I think the subject of this talk is 3 of my favorite trades. I'm going to teach you one trade that I've made most of my money in the past 18 months with. It's called a good night gold trade. It's where you risk $600 to potentially make $6,000. It's super, super simple. It's easy to do. Anyone can do it. It doesn't require, if you can add 1 plus 1, you can do it. All right, so it's super easy. It requires no special indicators. You just have to know some, simple basic math. All right, so that's the plan. And the network guy is actually working on stuff as we speak. Hopefully they'll get it fixed. If not, not a big deal. I'll still teach you some really cool stuff. So make sure that you do have your cards and you fill them out, and we'll do the drawing at the end. Like I said, my name is Hubert Centers. I'm the co-founder of TradeTheMarkets.com. My business partner and trading partner is headed this way, I believe. He's got a couple of talks that he'll be doing later this week too, John Carter. So one of the first trades I want to go through with you, I've got a slide deck here of a seminar that we usually charge about $3,000 for people to listen to and come and watch us give that presentation. First, let's talk about your chances of making it in this business. I am pretty much billed as the no BS guy about trading because I usually talk about risk a lot first up front. You may see some other people up here talking about it's all sunshine and roses and everybody can make it. It's a crock of crap. Not everybody in this room is going to be able to make it. So take a look to your left and then take a look to your right. 2 of you will not make it. All right? So now obviously you're looking at the other guy going, oh, you poor bastard, right? It may be you that's the poor bastard, so heads up on that one. What we do for a living is very risky. Do not trade with more money than you cannot afford to lose. In other words, only trade with risk capital. If you can't afford to lose it, don't trade with it. All right. What we do is risky. We trade futures. We trade stocks. We trade anything that moves. In the process of doing that, you get a thing that's called leverage, which is kind of a double-edged sword. When you're making money, it's the best thing since sliced bread. When you're losing money, it is the most painful thing in the world when you're trading with more money than you can afford to lose, and it just sucks. All right. So just remember that trading is risky. This is not an overnight success story where you're going to take $5,000 and turn it into $1 million. And I know I'm going to get tangled up in this bad boy and go straight down here in a minute. So a little bit of my story. In college, I was going to college to be a veterinarian. I thought I wanted to be a veterinarian and found out later that it was not my lifelong dream to be a veterinarian. It was actually my parents' lifelong dream for me to be a veterinarian. And I kind of figured it out 2 different stages in my life. As I was riding around with veterinarians, you have to, in order to get into vet school, you have to volunteer with a lot of veterinarians, all right? And that just means you get to be their free labor for years and listen to all their stories and watch them do cool stuff. In the process of doing that, I rode around with a lot of veterinarians, and the one guy that I put a ton of years in, his name was Dr. John Moran, and he was kind of sadistic. We would drive around in the countryside because he was a large animal veterinarian, and during the winter, he would make me roll my window down and go, might as well get used to the cold now. And I'll be like, that makes no sense at all. We're going to be out in the cold for hours. Why can't we be warm in the truck? So as he's driving down the road, I noticed there was something wrong with his thumb. And I'm like, Doc, what's wrong with your thumb? He's like, boy, that's not my thumb, that's my toe. And I'm like, okay, what's the story behind the toe on your hand? He's like, well, there was this heifer in a field. She swallowed an apple, and she was choking to death. He said, so what I did is I stuck my arm down her throat, and as I was pulling the apple back up, she bit my thumb off. I'm like, well, I've just killed the cow. Get the thumb back. He's like, I didn't feel like doing that. He's like, so they have this procedure where they amputate your big toe and put it on your thumb. And I'm like, so the second thing I thought, I was like, well, no, he doesn't even bite his toe when he bites his nail. That's a little gross. And then I was riding around with his partner, which is Dr. Phil Sims. Oddly enough, he had the same thing. And I'm like, this profession has some inherent risks that I did not know about. Evidently, I'm going to lose a thumb. And I was like, let me guess, a cow bit your thumb off. He's like, no, that's craziness. I'm like, okay, how'd you lose yours? He's like, I was tying up a heifer, and we were doing some checks on her, tied her up to a post, and the rope got tied around my thumb and zipped my thumb off. I'm like, I'm definitely going to lose a thumb. That's all there is to it. So that was the first kink in the armor. I'm like, this veterinarian stuff is not as sexy as what I thought it was. The second piece was, does anybody know how to pregnancy check a cow? It's a really interesting procedure where you put a half a body condom on your arm up to your shoulder. And then there's a reason why you pregnancy check a cow for a farmer is so that they can know how far along she is, if she's in milk production or if you're taking her to slaughter to the feed house. So what you do is you insert this, they call it a sleeve. It's actually a half a body condom is all it is. And then you lube your arm up and you stick your arm all the way up to your shoulder in a cow's rear end. That's how you do it. And then you feel and you palpate how big the calf is in there. And you can tell her, all right, 3 months, 6 months, 9 months, and they can take her out of circulation. So as I'm doing this, we're checking 100 head of cattle like this to let a veterinarian know. And you just, all right, next, next, you do that. I'm looking at the other veterinarian that's here, and he goes, son, why do you want to be a veterinarian? I'm like, well, obviously, you guys make a ton of money. You do what you want to. You come and go. You have no bosses. And as I've got my arm up a cow's rear end, sitting here trying to feel for the calf, he goes, dude, I'm still paying off my student loan, and all these farmers are my bosses. I'm like, that's it. I'm out of here. And I quit college, and I started a little fleet maintenance business where I was doing quick lubes on site for companies where it was a quick lube on wheels. And I figured out fairly quickly that if people think you're a mechanic, like if they know you know how to change oil in a vehicle, they think you're a mechanic. I wasn't. So what I would do is I'd sublet or I'd middleman markup mechanical work. So I worked a deal with a transmission shop where they would do the work on the vehicles. I would just transport them back and forth if they need major mechanical issues, and then they would send me a bill and I'd pay the difference. So one day I walked in, and the guy that owned the chain of transmission shops, his name was David. He's like, come on back here, we can settle up on these invoices that you owe me money for, and you can watch me trade. And I'm like, all right, what are you trading? And I walked around the corner, and he's got these two 21-inch cathode ray tubes back in the days, which were basically just big heaters. And he was looking at 400 equities, and he had the bid, the last, the ask, and the net. And he was just sitting there watching 400 equities. It looked like he was decoding something, and I was just fascinated. So we had lunch, and I sat down next to him. He didn't have a chair in there, so I flipped up the trash can that was beside his desk and sat next to him on an upside-down trash can. And I watched him make about $32,000 in 18 minutes. And I was hooked like a heroin junkie. I mean, I was like, how in the love of God did you do that? Do you do it every day? And he's like, no, I don't make money every day, but I do trade almost every day. And I'm like, what time's lunch tomorrow? Can I come back? He's like, yeah, come on back. Long story short, I end up sitting next to the guy for about 2 or 3 weeks before he looks at me and goes, son, I guess we should buy you a chair. I'm like, I'm going to need a chair, a computer, a desk. I'm never leaving until I figure out what you're doing, because you're making more money in a couple of days than I make in 5 or 6 months. I'm ready to go. I ended up doing an old school apprenticeship with this guy for 18 months before I placed my own trade, and which just means he would yell out orders at me and cuss at me, and I would do what he said. All right. So in the process, I picked up some really good habits. I also picked up some really bad habits where I didn't use stops. I would go all in everything. If they would give me 100% margin or 10,000% margin, I'd take it. He was kind of a cowboy. He was like, he had balls the size of church bells, in other words. He would just go all in. I mean, it was all in and all out. So in the process of doing that, he was trying to get me to man up and trade my own account. So as he was on a deer hunting trip, he would call me from the road and he'd be like, how are the accounts? You're managing the accounts. How much money have you made today? And on one deer trip, he would call and I'd be like, I'm up 80 grand. I'm doing fine. I've made us $80,000 today. And he's like, oh, no. You haven't made us $80,000. You made me $80,000. And I was like, you son of a gun. You're right, because I got zero cut of the profits. But I also didn't have to take any of the risk of the gains. He was just teaching me what he was doing for a living. So he's like, you need to just man up, take some money, and start trading it yourself. So at that point, I'd kind of let my fleet maintenance company kind of run into the ground. I ultimately sold it off to Valvoline, which Valvoline then ultimately ran it into the ground. But in the process, I scrounged up about $5,000, and in my first trade, quadrupled the account. So I went from 5,000 to like 20,000. I'm like, I am the man. All this hard work that I've done is paying off. I've took 5,000 and turned it into 20. This is awesome. Anybody want to know how the story ends on the second trade? You probably know because you've probably done the same thing I did. So I was in the second trade as I was sitting here high-fiving myself. You're the man. Yes, I'm a trading god. So in the second trade, interesting thing happened. This is where the stock was trading. I enter it, and it immediately goes higher, and I'm like, oh, I'm gonna triple this bad boy again. Piece of cake. Now, interesting thing happened. It went up, and then it went down. And then my stop was here. Does anybody know what a GTC order is? It stands for good till cancel. Does anybody really know what it means? Good till close. Because when that price action gets close, you just wimp out and go, oh no, right? And you move it, right? Anybody ever move a stop? You are all lying. I know you have. If you have not moved a stop, you have not traded for a living. So because you're trading too small. So as it comes down here, I'm going, oh, I don't want to take that loss. Move that down. And I'm like, okay, it can't go any lower. Wrong. It goes lower. In the process, I took that $20,000 and it went all the way down to where I was only up $2,000 on the original $5,000. So I was still up a couple grand, but a cold sweat came over me. I felt nauseous. I go to the bathroom and I throw up. So I physically threw up over losing about $15,000 to $20,000. In walks David and he goes, what's wrong, Susie? You having a bad day? And I'm like, well, what gave it away? You know, me throwing up in the sink or what? What's the deal? So he's like, get back in there and make it back. So I've been trading ever since. We actually got into the education business as an accident. We were doing some work with a hedge fund in New York called Pally Capital in New York. I don't even know if they're around anymore. And the Chicago Board of Trade, which used to be the Chicago Board of Trade, which is now CME Group, came and saw us that we were working with Pally. And at that time, we were trading the Dow E-mini, which I still trade today because I get really super cheap commissions where I'm a seat holder on the Chicago Board of Trade. And they're like, do you guys mind walking, traveling around to these traders' expos and teaching people what you guys do for a living? We're like, we're kind of busy doing our own thing. Thanks, but no thanks. They check us out, and they make the offer again, and we're like, all right, we'll give it a shot. We didn't know that you were not supposed to really trade live at these gigs. We didn't know that most people at conferences and stuff use PowerPoint, which if I had live stuff, we'd trade live, and hopefully it'll... Are you the internet guy? No, not the internet guy. So if we get live data feeds, I'll trade live for you. So we kind of got bum rushed or mauled by 400 or 500 people at a time going, how'd you know how to do that? And in most cases when we're trading at trade shows, we usually make money about 80% of the time and only lose it about 20 or 30% of the time. So it's probably a combination of luck and skill. But the people really respected that we were trading live in front of people. All right, so I'm long gold right now, and this is the profit I have since I went to bed last night. So we're up about $1,320, so $1,320. So I want to show you this trade first. All right, I'll share this one with you first. It's one of the most powerful trades that I can teach you that requires zero skill. All right. So anyway, that's how we kind of got into the educational game. And now what we do is we do a mix of we still trade and we still teach people how to do what we do for a living. All right. Do we make money every day? Anybody want to guess? Answer is no. Do we make money every week? No. Every month? No. Every year? No. Our goal in life is to make more money than we lose. Sometimes it works out like gangbusters. Some days it works in the opposite direction and it sucks. Okay? So same thing on the risk. All right? So the first thing I'm going to do is I'm going to use TradeStation because TradeStation is one of the main brokers that I use for this trade. The reason I do it is because it makes it super simple, easy. I don't have to worry about anything. The first rule you want to know is where gold closes at for the COMEX pit session. So that's at 1:30 p.m. East Coast time. Everybody say it, 1:30 p.m. East Coast time. Everybody say it or I'm not talking again. All right, the reason I say that is because I'll do this talk and I will get 300 questions like, was that East Coast or West Coast time? Is that so 1:30 p.m. East Coast time is when the COMEX pit session closes. All right, you want to write down what that price is at that time. All right, so that's the first rule. There's only 3 rules to this trade. That's the first one. Where does gold close at 1:30 p.m. East Coast time? Now, I know that it closed $21.50 lower than it is right now because that's how TradeStation does their settlement on this, okay, for their net change on gold. All right. The second rule you want to know is gold in an uptrend or a downtrend? All right, so what we need to do is we need to look at a daily chart of gold really quickly here. Now, oddly enough, gold is still, it was until about 4 days ago, it was in a real good downtrend. Does everybody agree? All right. And what I do is on the time frame, I look back at gold, and over the past 2 or 3 weeks, I want to know, is it trending up or is it trending down? If it's trending up, I want to focus on the long side. If it's trending down, I want to focus on the short side. So let me zoom in here, and I will get rid of a lot of these indicators. So we'll just focus just purely on price, because a lot of times indicators can be more of a nuisance than a help. Format analysis, status. All right, so now we're just looking at a raw picture of price action. So this is today, yesterday, day before yesterday, day before that. So that's a big move in gold. So on that bar, gold told you that it was going down, and it changed its mind, and it now decides it wants to go up. So the first rule is where did it close at 1:30? Second rule, is it in an uptrend or a downtrend? Now here's the easy part. At 11:30 p.m. East Coast time at night, okay, so almost midnight. At 11:30, if gold is in an uptrend, okay, and if it's up more than 3 points from what? From the 1:30 settlement price, you're going to go long gold, okay? If it's in an uptrend, which we are. And last night, it was up about 8 points before I went to bed. So it was up more than 3. Now, there's a sweet spot in the trade. You want it to be up more than 3, but you don't want it to be up more than, say, 15. The reason you don't want it to be up more than 15 or 20 is because the average true range of gold right now is about 25 points. So if you're already up 15, and if I'm risking 6, I don't have a good risk to reward ratio. All right. Here are the stops and the targets for this trade. You're going to risk 6 points, so per contract, so that's $600 per contract. So we're going to risk 600 to potentially make 6,000. All right. You can decide to cut it loose early if you want. I try my best to try to hold it all the way through. All right. Now there is a sweet spot for the trade. Sweet spot for the trade is risk 6 points, which is $600, to make 1,800. Okay, and that works out pretty good. Now, the success ratio for this trade, oh my God, is not 92% like a lot of people will bullshit you on. All right, it's only about 30 or 40%. All right, but you only have to be right 1 out of 10 times for this thing to break even. Anything above 1 out of 10 times, you're going to be in the money. The sucky thing about that is, what if you have to go through 10 trades before you find that first one winner, right? So that is the sucky thing about the strategy. But it only has to work 1 out of 10 times. And on average, it works about 3 to 4 times out of 10. So in other words, I'll lose 600, lose 600, lose 600, and then boom, make 6,000. All right? There are some decision points along the way. If you don't feel like you're confident enough to hold it for the whole $6,000, then make a decision to keep it or cut it loose every 20 points, because gold averages 20 to 25 points a day. So on average, I'm usually in this trade anywhere from 3 days to 3 weeks. It just kind of depends on what's going on in gold at the time. Now, what do you do if, let's talk about drawdowns. What do you do if you do the trade like I did the night before last and it doesn't work? Well, I'm willing to do the trade 3 times in a row, loser, 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 before I go, okay, gold's just messed up here. Let me kind of reassess and see what's up with it. So I'll give it 3 strikes at the bat before I hang it up and go, okay, I'm going to wait a couple of days until gold makes its mind up. All right. So the night before last, it got me, and the night before that, it did not qualify. But last night, it actually worked. So when I went to bed, it was up 8 points. It fulfilled the criteria, and now you can see we've We've given about a point back. You can see the entry last night was, where was the entry at? Entry was 1625.60 was the entry. And down here with TradeStation, down here's the stop. So you can see I'm risking 600. Now it'll take us a day and a half to scroll all the way up here to see, well, maybe not. I'm getting close. All right, so there's the target. Okay? And TradeStation is really powerful. It'll just go ahead and set up everything for you so that you've got a stop placed and a target placed at the same time. All right? Any questions on good night gold trade? It's how I've made a large sum of the money that I've made over the past 18 months. It's a super simple, easy trade to do. Requires no indicators of any kind other than you just need to know when it closed, at what, and at 11:30 at night, is it up more than 3 from then or down more than 3? And if it's in an up or a downtrend. Any questions? Nothing? Quick, go ahead. I do. It's a mathematical formulation. What I do is I go like this. I look at the chart and go, that's an uptrend. That's how I do it. No, I just look at the chart and go, it's either up or down. Like as of 4 days ago, it was in a downtrend just from eyeballing it is the way I look at it. And you'll be able to tell. I mean, a good rule of thumb is if gold's up more than 3, it's going to be up on the day. If it's down more than 3, it's going to be down on the day. How many people in here trade E-minis? What do you guys, all right, so how many people trade stocks? Options? Futures? Forex? All right, so more stocks and options traders than anything. So E-minis are a great way to burn money. Does anybody know how to burn money? E-minis are a wonderful way to do it if you're trading the wrong instrument with the wrong strategy. So E-minis are a good instrument to trade if you use the right strategy. They're kind of like sprinters. They run, stop, and reverse. So in your all's adage, for a stock trade like Google, Amazon, Apple, something like that runs, stops, comes back, like real violent, that's kind of how the E-minis are. They'll run, stop, and reverse, run, stop, and reverse. They're not really conducive to grabbing something at a new... Anybody ever tried to buy a new high on a stock? Or sell a new low on a stock? Bunch of liars. So it doesn't work out really, really good unless it breaks out and it has a personality where it's a marathon running stock where it breaks up, it goes higher, 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 pauses, and then keeps on going higher, 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 right? So gold is like that. It's more like the Energizer Bunny or like a marathon runner. It'll just keep on going and going and going. Where the E-minis, and in some instances, some stocks, just like to chop you up. They'll do false breakouts, come back and get you. And then you'll swear up and down it's those damn specialists and market makers coming after you. And really, it's just because you don't know how to trade. It's not because the evil specialists are after you. So let's talk about a little bit about brokerage firms. And you all know that brokerage firms watch you trade, right? I mean, they watch what you're doing. They have to do it for compliance because if you get upside down on a trade, they don't want you to go and take down the entire firm. So what they do is they have risk management in place, and they're sitting there going, so give me, all right, Roger. We'll say Roger's trading, all right? So Roger's long 3,000 shares of Google, all right? And then all of a sudden it goes to his stop, and then Roger moves his stop. And they're going, oh, watch Roger here. Roger moved his stop again. Look here. Oh, Roger's getting ready to add more. Look here. Beep, beep. They can actually see exactly what you're doing. So the next time you start doing some crazy stuff that because you're a hermit and you think you're the only one behind that screen, and you're going, nobody will know. Somebody else knows. So it may keep you from doing some irrational behavior of adding to stuff, not using stop losses, jumping out because you're scared. Somebody is watching you somewhere. They're not trading against you. That's illegal. They'll go to prison for that, or at least get fined, I guess. It depends on if they get caught, I guess. But that's one of the things that you should consider, because most of the trading that goes on, like how to profitably trade, 90% of it's a head game, and the other 10% resides between the 6 inches between your ears. All the technical analysis and all the other stuff, you can probably be taught that stuff in 4 hours by somebody that knows what they're doing. Then it just comes down to just good old-fashioned experience of getting your teeth kicked in enough times to know, like, hey, that's a bad idea. All right? So any other questions on good night gold? Yes.
You said about risking 600. Is that something that you do with a futures? Is that a futures?
That's with the futures contract. That's with the big GC contract. That thing is $100 a point. So every time it ticks up, so if it goes from $1,637.60 to $1,638, that would be 3 ticks. All right, that would be $30. So every time it moves 10 cents, it's $10. All right. Now you can do the same thing with GLD, which is a gold ETF. You just can't trade it at 11:30 at night because it's closed. So what you're going to have to do is figure out if it's up or down at 1:30. And now gold only is down for 45 minutes. It shuts down at 5:15 and reopens up at 6 o'clock. When does GLD close? Does anybody know? I don't trade a lot of 4:15. So you're going to have 4 o'clock. So you're going to have to execute that trade at 4.
I've traded it after hours.
Does it trade after hours?
For a few hours, I don't know exactly.
I mean, so you can modify it to work for you. All right. Any other? This is a futures contract. Yes, this is a futures contract.
So on this, how many points are you looking at to get up to 6,000?
All right, so if I'm risking 6 points, that's 6 points. So for 6,000 points, I want to make 60 points. So if the thing runs, 20 to 25 points a day, let's just say 20, it'd be 20, 40, 60. In about 3 days, I should know, I should be getting close to my $6,000 profit if gold's cooperating. If it continues to rise or drop in my favor. If it's going to be sloppy and choppy, it might take 2 or 3 weeks. So yeah.
So you said $1,800 is a sweet spot. I
Hmm?
mean, if you were to take off your profit, would you think you'd win about 80% of the time?
I don't know if it would be 80% of the time. And so there's nothing that's really that good. Most of the professional traders that I know, most of us are only about 50% correct on what we do. So if you ever hear anybody, I mean, I've got some trades that have a higher percentage win success rate, but it also depends on what's going on at this particular time. Like, it's 82% right now. In 3 weeks, that thing can drop to like 22%. All right, so anytime that you hear, well, this thing works 98% of the time, put your hand on your wallet and walk out of the room. Because just because it's working now does not mean it's going to work for the next 2 days or the next 2 years. Any more questions? Good night. Mm-hmm. All right, so the question is, if you can't hear the question on the recording, so you have a 6-point stop loss, but do you also have a time loss? So in other words, if your stop is not hit and your target is not hit, do you have a time loss? I do not. I just stay in it until either the stop is hit or until the target is hit, is how I do it. I'm not saying that's right or wrong. I'm just saying that's how I do it. You may want to jump out. Usually, does anybody else in here suffer from premature profit taking? Does anybody know what it is? You can't cure it with a pill, oddly enough. I wish you could. I'd make $1 million like that. And I did a joke. Like we put out these free videos that trade the markets. And I kind of got a weird sense of humor. So I made a joke about, do you suffer from premature profit taking? And I was trying to make it like an erectile dysfunction. And I thought it was funny. All right. Some of the females on the newsletter list did not think it was funny. But anyway, premature profit taking is where as soon as you're up a couple $100, you want to take it and get out of Dodge, right? Because you're like, I want to take that money because now I'm up a couple $100, or I'm up a couple thousand, or I'm up 10 or 20,000. I'm gonna go ahead and take it. Do you know why you do that? It's just because you've got so much residual left from your losses that you think that's all you're about, and you're like, oh no, I know it's going to turn into a loss, so I'm just going to go ahead and take it. And then what happens after you take it? Does it go higher or lower? It only goes higher by about 1,000 points, right? And you're sitting there kicking yourself going, my God, why didn't I stay? So try to, if you can, try to develop up a business plan or a trading plan and try to get yourself to stick to it as much as possible. All right? So there's another trade that I want to talk to you about. It's about trading gaps. Stan, what time do I leave? What time am I done? 9:15. Okay, I got time. So there's another trade. It's called gaps. So I'm going to teach you how to trade gaps on futures. And if you trade stocks, if it's a market proxy stock, it should work with your stocks too. This is what a gap is on the Dow, on a gap. So that's where it closed yesterday. here's where it's opening up at today. So in other words, it's up 87 points. Okay? I don't really want to short that one today, but in most cases, I would want to short that because most of those gaps will fill by the time the market closes at 4:15. It's a really high success ratio for that, and so here's why you would want to do a trade like that. So let's go over the theory first. Also, this helps if you're a trader. This helps a little bit. It helps if you have a brain like a squirrel. Now, if you're looking at that image and you're thinking anything else, that's on you, not me. I'm talking about his brain. So this is why you would want to do a fade on a gap. So Mondays, gaps fill about 65% of the time. Tuesdays, they fill 77% of the time. And I swear, I'm not ignoring you guys over there. I only have like a 3-foot leash. Wednesdays is 79% of the time. Thursday is 82%. And Friday is 78%. All right, let's talk about real world. What this means is if you have a gap up of 87 points, it could potentially go up another 400, but it may fill that gap by the time we reach 3:15 today. Does that make sense? It does not mean it's going to fill within the first 15 minutes. All right, so we've got a gap up today of 87 points, and it may run higher before it gives a lot of it back. So that's what stops are for. Now here's the other back testing model. On a 1-point gap on the S&P, that's 10 points on the Dow. All right. So if it gaps up 10 points on the Dow, it has a 93% chance of filling. On a 20-point gap, it has a 90% chance of filling. So where are we at today? We're down here above 7 points, right? A 7-point gap up, or 70 points on the Dow, fills 71% of the time. When you get above 8 points, look at what happens. It drops off, right? 50% of the time. I don't want to take that bet, right? Now, if we gap up and we're on a Thursday, I'll do that trade, all right? If we're up 20 or 40 points and it's on a Thursday, I've got some good percentages in my way, then I'll fade that. In other words, I'll short that gap up. You also want to take into effect, is the market in an uptrend or a downtrend? And right now, what are we in? Down with bounces. So which one do you think is going to fill more often right now? Down gaps or up gaps? Ups. Ups because we're in a downtrend. So if we gap up, that's going to be a gift. All right. Now I still don't want to short it when it's up 80 because it's kind of going against me, right? So the sweet spot for that is 20 or 40 points. 40 points would be a good one. We could short that one, use a 20-point stop loss, and then see if it's going to drop lower. All right. There's a way that I'll enter that to keep myself safe. The best trade that you can take is a half a gap fill. So in other words, if we're looking at a half a gap fill, half of this range, there should be a drawing tool, but I can't find it. Half of this range is going to fill about 80% of the time, 82% of the time. All right? A full gap fill is going to depend on how many points it is and what day of the week it is. Now there's going to be some information that you need to know about, and these are the numbers that you need to know. All right. Options expiration drops 2% from a 78% gap fill to 76. Monday after options expiration drops 13% from 65 to 52%. Heads up, I use a lot of numbers just because I'm dyslexic and I can't spell, so numbers are easier for me. But trading is just a pure numbers game. Numbers and emotion. You may have, we probably have several millionaires. We may even have a couple billionaire demo traders in here, all right? You can't really cash that. Has anybody ever tried to take your demo account down to the bank and go, I just like to go ahead and pay the mortgage off? They won't actually take that stuff. Demo accounts are really good for theory. They're not really good for like how you're going to act in a real world situation when your hard-earned money is on the line. So demo accounts are good for like teaching you how to hit the right buttons, like this is a buy, sell, this is a trailing stop, this is a market order, a limit order. They're good for that, but they're not really good for like teaching you how to trade, all right? Because they don't have what this thing, and this is a really technical term, it's called the pucker factor. Does everybody know what the pucker factor is? It's about how tight your rear end will squeeze when you have money on the line. So when you have a demo account, you're like, oh, I'll just do this, do that, la, la, la. Then when you put real money on the line, you go, and you freak out a little bit, right? So just be aware of the demo and the pucker factor. So here's a slide that's got numbers that decrease the chances of a gap fill. There's a really easy way to look for an entry on a gap fill. So on a gap down situation, what I'm looking for at the open is I'm looking for 2 blue TTM bars in the opposite direction. So if we're gapping down, I want to wait until 2 bars turn blue for me on this TTM trend. 2 50-tick bars. Once that happens, I can then go long. All right. Same exact situation would be for today. If I'm gapping up, I want to wait until 2 of these bars are red. Okay. Here's all this little indicator's doing. So on the left-hand side is a candlestick chart. On the right-hand side is the TTM trend. And all it's doing is it's just a easier, simplified version of gauging an uptrend or a downtrend is all it's doing. Nothing more, nothing less. Here's how this indicator is calculated. It looks back 6 bars. So it goes back 1, 2, 3, 4, 5, 6. And it gives you the 50% average true range of those previous 6 bars. And it draws a line. All right. If a bar closes above that line, it goes, hey, I'm changing direction. Of the previous average true range of the previous 6 bars, if it closes above 50%, my direction in the market is changing. So you want to have a heads up. So it'll go from red to blue. Now in my case, I want to have 2 of those. Okay? 2 in a row. So if I'm going down, I want blue, blue. If I'm going up, I want red, red. This is the code. It's our modified version of a Heikinashi or Heikinashi, however you want to pronounce it. It's a Japanese form of charting methodology, and here it is. You can probably search TradeStation's Easy Language Forum and find something close to it. They're really good about that. If anybody wants these slides, how are we going to get those? Support? Email support@tradethemarkets.com. Support@tradethemarkets.com. All right, so let's go through a potential gap trade. So let's talk about, all right, so this is going to happen a lot. And I like live trading as opposed to PowerPoint. So number 1, what is today? What is the day? The 6th. Is it Wednesday? All right, so Wednesday, let's see how many, all right, let's take a look at the percentages. So on Wednesday, gaps fill about 79% of the time. We're going to pretend it was an 80-point gap. We only have a 54% shot of that working. I'm not doing it. You could do it with your money, but I'm not doing it with mine. All right. Now, if it would have been a 4-point gap, I'd been all over it. All right. If it's 3-point or 40 points, 30 points, 20 points, 10 points, all over it. Even if it would have been a 60-point gap, all over it. Gets above 70 points, you got to be a little careful. All right. So that's one of the reasons we're not going to do that one. But let's pretend that we were going to do it. Here's how we would do it. At the open, at 9:30, we're going to back up just a little bit here so that you actually know exactly how to do this trade. There's 9:29, so here's 9:30. So I would have to wait until I had 1 red bar, 2 red bars. So there's red, red. Does everybody understand? That's what I wait for. So if it would have been a gap up of 40 points, and at the open I had red bar, I would then short that. Same thing if it was a gap down of 40 points, I'd wait for blue bar, and then I would just go long. Now, I use a 20-point stop loss, and I scale out of the thing about every 10 points. All right. Now, my commissions are cheaper than yours just because I get professional courtesy because I have a seat on the Chicago Board of Trade. You can get one too. There's nothing magical about it. I have mine through TradeStation. I just link it up. And I just tell them, like, hey, here's my number. Now knock my commissions down. It doesn't take any money out of TradeStation's mouth at all or out of their hand. It's just you just lease a seat on the Dow. It's called an IDEM seat lease. It costs $2,000 up front, and then it lowers your commission almost in half. It knocks it down about $1.75. So for futures, it's going to cost you about $5 to go in and out of a trade. Okay, for a round turn. Okay, all right. So TradeStation will help you set it up, and they'll also hook it up to your account. It's super, super easy. It'll save you a lot of money. It's not hard to do. As long as you're not a terrorist, you will qualify. okay? And what it happens is it lowers your commission by about $1.75, and it only costs like $80 a month to do it. Yeah, after you pay your one-time application fee to the Chicago Board of Trade. So any questions on gap trading? Now, gap trading will actually work on equities. So there were a lot of equity traders in here. It'll work on equities too, up and down, if they are a broad market stock. Like, it's not going to work on something that does not move with the Dow or the S&P or the NASDAQ. So it's going to work on, everybody understand the theory of all boats ride with the tide type of thing? If it's one of those stocks, it'll work. If it's not, it probably won't work. The only thing I don't like about trading gaps on stocks is lots of times it'll be news related. It'll be like the CEO ran off with the accountant or something like that. And you're like, whoa, why is the gap down 200 points? Oh, because they have two CEOs and they've lost their minds. So that's the second tactic. So let's see here. What else can we talk about as my money is evaporating? I have. Do I ever get out when that happens? No. I'll let the great question. What question is, do you ever get out when that happens? Like when we started, we were up $1,300, right? Now we're up. What are we up? We're up 1,000. So we've given back about $300. I won't. I'll let it come all the way against me and lose $600 on the trade, because I'm trying to hold it on. I'm trying to hold on to it until it goes up at least 20 to decide, all right, I'm going to cut it loose. And then once it gets up 20 points, I'll decide I'm either going to keep it or I'm going to cut it loose. Then when it's up 40, I'll decide keep it or cut it loose. I don't really suffer from jumping out of it too early. I usually suffer from staying a little bit too long. And I almost always miss the first 25% of a move, and I always miss the last 25% of the move. But I'm decent at getting 40 or 50% of the chunk in the middle. Question. So it's a future strategy. Will options traders be able to actually trade it? You can do options on futures. You can do that. Yeah, or you could do it on the diamonds, the QQQs, the spiders. You could do an option on an ETF or something like that. It should work just fine. Yeah, usually on gold, I'll start out with the smallest possible position I can because it's so leveraged up with one contract. Usually in gold, I'm not usually about the longest, as many contracts I'll trade on gold will be anywhere from 8 to 16 contracts. So yeah, if I start out with like 4 or 5 or 6 or 8 or 10, yes, when I get to 20 points, I'll peel off half. And when I get that plus 40 points, I'll peel off a quarter. So I always go all in and then go out half, quarter. And I try to hold on to the last quarter as long as I possibly can. In other words, I reward myself for doing the trade mechanically correct for the first 3 quarters of it, and then the last quarter I'm just swinging for the fences. I'm just trying to see how long I can actually hold on to it. That's what I'll do. I don't. So follow-up question is, once you take some of your profit after you've scaled out, will you move your stop up? No, I don't. I'm not saying it's right. I'm not saying it's wrong. Just for me personally, I don't do it. I keep the same stop because it's kind of like this cord that I'm dangled around here. This thing is so tight, I can only go about this far before it starts tangling up around me. If I move my stop tighter, what's going to happen? I'm going to get tangled up in it. It's going to take me out of the trade. If I give it a little bit more room, I can walk around and I can go up and down, right? I can still get tangled up, obviously. So I can still move around a little bit more, and that way the market, I can move with the gyrations of the market, still be in it, and if I've got the direction right, I'll be rewarded. So I don't tighten up the stops too tight. And there's kind of a science, kind of an art to it. So what I've come up with is I'll just leave my original stop, and I'll just decide, keep it or cut it loose, keep it or cut it loose. Now, if you make like 200 points on something, there's nothing wrong with moving it into the profit. There's no sense in letting it come all the way 200 or 20 points all the way back against you just because you're stubborn, right? So, all right, so I've got enough time to teach one more strategy. I can teach you either a swing trading strategy on stocks, or I can teach you an intraday strategy for stocks and futures. Which one do you guys want? So that sounds like So all right, so swing trade, hold your hand up. All right, intraday trade. So great. Half of you want one, half of you want the other. Yeah. That's awesome. All right, so interesting. Let's do this. Okay. One of the best ways to scan for stuff is, all right, let's do the intraday first one. Intraday, and then I'll do swing. Because this intraday strategy will help you time a lot of your swing trades. So the first trade that I'm going to teach you two tactics, and it's going to be write down this symbol. In TradeStation, it's tick. Cash sign, T-I-C-K. Cash sign, T-I-C-K. This is the RPM gauge of the market. It's going to help you for your intraday trades. This thing's driving me nuts. Intraday trades and your swing trades. There's two different trades you're going to do off of it. A extreme tick fade and a tick hook trade. So an extreme tick fade is like this. Any movie buffs in the room? So anytime a tick extreme hits a plus 1,000 reading, that's usually all the market's got. So in other words, it's a marathon runner and it's hit the wall, it's going to just start gassing out. Or it's a machine gun and you're just, and you've got to reload. That's what a plus 1,000 tick reading is. So let's see if we've got any plus 1,000 tick readings today. I don't believe we do. Not yet. So yesterday we had some plus 1,000 tick readings. This is what it looks like. So what you're looking at is you're looking at a chart of the tick with a 1 period moving average on it. Anytime that you get a reading where the tick is plus 1,000, you want to short that on the first reading. Anytime you get a minus 1,000 reading on the RPM gauge, you want to buy that. So now you can translate that into intraday stocks and futures. If it's futures, this will be for the Dow, S&P, NASDAQ, and Russell. If it's equities, then when it hits minus 1,000, that's when you want to buy your stock. If it hits plus 1,000, that's when you want to sell your stock. Okay? So that's all it's got. In other words, it's just the market's giving you look here, we actually almost have one here. Look. So at plus 1,000, so we got plus 963. What should be happening is the Dow should be going higher. See how it's going higher? So at plus 1,000, what we would want to do is we'd want to short that in the anticipation that that's all the market's got. It's emptied all of its chambers. It's given you everything that it's got. It's at plus 1,000. If you were already long, you would sell up there. If you're not already long, you would short up there. Does that make sense? It's a market timing mechanism. Every platform out there has the tick. It's a market internal. It's the NYSE on TradeStation. It's cash sign TICK. So that's one of the trades. All right, so it's a tick extreme. Yes?
Do you have to plug in something for like a specific future for that?
You do not. All you have to do is just go like this right here. You just type in cash sign TICK and hit enter, and then it'll just refresh itself, and then boom, you've got it set up. Now, it is an NYSE market internal, so you do have to have access to that, but you don't have to have access to futures in order to do that, no.
But then so for whatever future would go down after that?
Yeah, so then it's going to, this is an RPM gauge for the market. It's going to work good for the Dow, the S&P, the NASDAQ, the Russell, and any other broad market equity. In other words, that moves with those other indexes. So that's the RPM gauge. It works just like the RPM gauge in your car. If you have your RPM gauge in your car pegged at 7,000, what's going to happen? Or 10,000? You burn up the motor, right? You're going to blow up. Same exact thing here. It can't stay at 1,000 for very long. Now, it can go to 1,000, it can go to 1,200, but it's going to come off sooner or later. Or it's going to go much, much, much higher. And the odds are is it's probably going to come off because it's going to burn up the motor. All right? Same exact thing. You can't go negative 10,000 RPMs in reverse. It'll, ratchet the transmission up, mess up the engine too. Same type of thing. So that's the RPM gauge. So that's one trade setup. Let me go through another trade setup that I think you'll like, which is called a Darvas box trade. So there's this book, and it's called How I Made $2 Million in the Stock Market. And it's a good book. You should read it. And here's the theory that it uses. So give me a stock. Let's go AAPL. So there's this one guy that calls me to this day, and he was long. This is a horror story. You don't want to be this guy. I forget his name. Mark's his name. Mark has been short Apple. He's been short Apple since $150. And Mark calls me on a daily basis asking me what I think he should do. So my first advice was to hide all the handguns, knives, and ropes. And he's like, I agree, it's probably a good idea. Mark lives, I think, in Wyoming or Iowa or something. And he calls, and I feel sorry for the guy up to a point. Because at 150, I was telling him, get out. Get out. At 200, I was telling him, get out. Anybody ever watch horror movies where you got a group of kids go into a house and you hear, get out. Get out. And they walk into the next room going, what's that noise? And you're like, that's not going to end well for you. It's saying get out. That's what Mark is. I mean, now the odd thing about it is, at 600, Mark finally decided to get out and that Apple was going higher. No lie, swear to God. I've got it on recordings. And I use it as a teaching example in our trading videos and in our live trading room. I'll put him on speakerphone. I'm like, Mark, do you mind if I put you on speakerphone so somebody else can learn from your example? He's like, yeah, sure, great. And I think he just loves pain. All right? So you don't want to be that guy. So make sure that you use stops. So in this strategy, this is called a Darvas box. This is going to make your life a lot easier. It's an indicator that you can get within TradeStation. We sell it over at Trade the Markets. Anytime you break out of the top of this box, that's considered a long. Do you see where I'm pointing there? That's a long. This is a long. This is a long. This is a short. This is a short. And now this is a long. Here's how you trade this thing. Okay? If you were fortunate enough to be long Apple here, then what you would do is you'd be long here. You'd either use the half the width of that box or the full width of this box as a stop loss. Okay? If you're using half the width of the box, you would use half the width as the first target. If you're using the full width of the box, then the target would be the full width of the box. All right? So let's talk about equities. Throw out an equity that you're interested in, and I will tell you what this magical little indicator says to. First, are there any questions on how you trade this? It's dead simple, right? I like using stuff that's dead simple because I'm not the sharpest axe in the shed. So if I make it simple so that I can understand it, you should be able to handle it too. So in this example, on Apple, we would have shorted it here. We would either use a stop loss of half the width of the box. If we did that, we'd have got stopped out. If we used the full width, we would still be in it short. All right? So let's go through just any stock symbol.
Can you use some indexes?
Oh, sure. You can use it on anything. This is just a chart pattern that's developed up from the book, How I Made $2 Million in the Stock Market. QQQ? Okay. QQQ. All right, so the QQQ has said you wanted to be short here, here, and now you want to be long there. And now it's in a box right now. So you can't do anything in the QQQs until it goes above 63 or below 60. Anybody else got another one? Another example? Stock trader? Give me something that you're in that you're just hating. SHW. So Sherwin-Williams actually looks pretty good. You can see that it's got a box that it just broke out of about 5 or 6 days ago. It's in a consolidation range, but if you would have went long Sherwin-Williams at about 125, your stop would have been about 120 or 114, and your target would obviously be higher based upon half the width of the box or the full width of the box, depending on which either stop you're using there. But it looks good. You can't trade it again until it goes above 130 or below 123. Anybody else got another one? GBG? GBG. 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 So GBG had a break. What in the hell is that thing? Great Basin Gold. All right. I just usually never trade stuff below $5, but we will look at it this time. If you would have went long at 55 cents and used a stop at either 51 cents or 47 cents, obviously you'd be happy. And right now there's no consolidation just because it's on a pure breakout play. But looks good long.
The size of the box that's breaking out, if it's bigger than the average box for that stock, smaller?
It doesn't really matter. What you're looking for is the consolidation was a high made. Oh, question is, Question is, does it matter the size of the box? The size of the box does not matter for the percentage success win-loss ratio. It's actually a mathematical relationship based upon was a high placed first or a low place, or was the low placed and then the high. So if it's yellow, it means the high was in place first and then the low. If it's purple, the low was placed first and then the high. So it doesn't, go ahead, shout it out. Darvas box. Darvas. D-A-R-V-A-S-B-O-X. Darvas box. Huh? Capital D? Oh, C-T? I thought you said capital D. I was going I don't think it's really going to matter. Yeah, you can find it in Trade Station. We sell it at Trade the Markets too. Caterpillar, you can't short it again until 82, and you can't go long until 93. So, yeah. Time frame, question is what time frame? It can be applied to intraday or day. Any time frame. Just pick your time frame and it'll kind of tell you kind of what to do. Okay, so on the box, if it's yellow, the high was made first and then the low was in place. If it's purple, I think, I maybe reversed them in my head. I have to look at the rules. Purple just means either the low's in place first and then the high, and yellow may mean the reverse. Yeah, I'm dyslexic, so I shift stuff all the time in my head. All it means is the high or the low is in place first. The color is really not that important. It's just a visual representation to let you know what's going on. You want to know, is it breaking out of the top of the box or the bottom of the box? That's all I've got. If you've got questions, I'll be up here for the next 5 minutes. Thanks for coming.